Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, what are the common mistakes made by a first-time investor in stock markets? Answer by Tom Brown. Remember one fact that the more you risk, the more you can earn. And one more advice for you, you should try to avoid the great mistakes. How to avoid them I will write below. You know, everyone can make a mistake and a lot of traders or investors have made them. As for my mistakes, that can be the same with people who had answered this question. Of course, one of my mistakes is a fear to invest because of my youth and poor experience. But mostly my mistakes are deal with the situations that I'll try to describe below. The main thing for us is to reach the goal, overcoming mistakes and using financial literacy. Don't be afraid of mistakes and risks. On error you should learn, and try to control the risk. From my point of view there are a lot of widespread mistakes that investors make. Below you can see a list of mistakes which I recommend not to make, because I have made them and know the results. 1. Investment in fashionable assets. At the beginning of the 17th century the fashion for tulips was in the Netherlands. Bulbs of rare varieties in great demand, and its price has risen steadily. The booming market of tulips captured all, florists, businessmen, civil servants, small shopkeepers and even footmen. All bulbs are bought for resale. In 1636, the price of a tulip reaches the value of a home. But when supply exceeds demand, prices have dropped on tulips many times, which led to the ruin of many hapless speculators. The situation where an excessive demand for some assets with a view to its sale results in the rapid growth of prices, called bubble. And any bubble is known to eventually bursts. The Dutch experience has taught investors anything, and since then the speculative bubble inflated and burst several times in different countries. 2. The sale of shares after the bad news. When the stock price falls, many investors feel akin to terror. And what if it's the beginning of a downward trend in the market, which will lead to large losses? And then there is the temptation to sell the shares in time to minimize their losses. Novice investors often sell their shares even after a slight drop their prices, and the next day discover that the market played yesterday's losses. These are professional players and fraudsters, who make good on this. The most experienced may even manipulate the markets, whom specifically spreading good or bad news. 3. Playing in the financial casino. Sometimes actions are seen as an easy way to profit. It would seem that what could be simpler, buy stocks, wait for the market growth, sold at a profit. I tried to increase profits. These investors often take the money in a loan secured by, for example, an apartments. But when the market falls, investors are left without money and without an apartments. Shares trade with a view to get rich quick is not called investment and speculation. Speculation stocks akin to a game in the casino. You can win by chance, but the more you play, the more you lose. 4. The desire to get everything at once. Many people read popular books on investments, imagine themselves to be Warren Buffett. Choosing the best stock, they immediately put it in a large amount. And then we are surprised when the stock lags behind the market or brings losses. This happens only because the rules are neglected: investment diversification and gradual entry into the market. The worst part is not even that these investors lose money, but the fact that they have a stable allergy to any further investments in the stock market. 5. The rate of success is repeated. If you find out that your next door neighbor invests in mutual fund earn last year 40% per annum, do not rush to follow in his footsteps. Yes, lucky neighbor, but the market does not stand still, and after a year can easily fall. If you hurry to invest in the same mutual fund money, it can be anything else. Firstly, the growth of the market in the past does not necessarily mean that it again in the future. Secondly, we should not blindly copy someone's strategy. You do not know how much time and effort spent your neighbor to play well in the market. In order not to be an investor who becomes to bankruptcy, I suggest you obey some simple rules. Formulate your vision, taking into account the investment objectives, attitude to risk, age and so on. Otherwise, the scope of the investment will be for you a cat in a bag. Start with simple tools, such as mutual funds, and as they gain experience, go to the more complex. The same principle should be applied when choosing a strategy. Start with a conservative and move to more risky. Stick to the chosen strategy, not trying to catch a dubious success. Investing in the stock market is calculated on a horizon for at least 2 years. The investor often simply doesn't make friends with the calculator or lazy to properly examine the object of investment. More often stocks bought simply on the advice or example of friends amateurs reduce the risk of loss due to diversification of the portfolio and the gradual entry into the market. Remember, investing in the stock market is not the way to get rich quick and long and hard work. Investing, even trading, still a long process. You can't be rich instantly. Of course, you can avoid mistakes reading some articles like these ones, but even reading books and pieces of advice of successful investors never give you 100% guarantee of your investment quality. That's why I recommend you obey the rules and recommendations above. Also, I recommend you to read blogs of famous investors and their experience of investing. Sometimes it's interesting. Answer by Benoit, only for new investors. Hello, beautiful people of the world. First of all, spare me for my bad grammar. I'm Benoit, and am very new in the stock market. I have learned a lot from my mistakes and experience. So here we go. If you're getting SMS like this, just delete it or block the number. Trust me, never invest in such stocks. Such texts are part of some greedy promoter's game to increase the price of a particular stock, so that they could sell their own stock at high price. I had added 1,000 shares, at a price of 223 Indian rupees of BRFL Bombay Rayon Fashions Limited on December 18, 2017, after seeing such an SMS as you can see in picture below. The current market price on 22nd of January 2018, of the same share is, current market price, CMP, as you can see above, is 84 Indian rupees and 80 paise. However, I exited share on 4th Jan 18 at 104 with incurred loss of 119 per script. That was 35% of my capital. This was one of my first mistakes in dealing stock market. How these SMS and so-called free stock tips work to cheat new investors. Read very carefully. I bet you will be shocked at the end. I am Mr. Fraud Kumar. Suppose I am giving you free stock tips. This is how my scheme will work. I would contact a broker, let's call him 10, and one will get the latest retail investors database from that brokerage firm at a very minimal price. Yes, you can easily buy investors' details, although not all brokerage firms are involved in such activities. Suppose I had bought details of around 2 lakh new retail traders who recently entered in the stock market and are active traders. I divide these traders into 2 groups of 1 lakh in each. Let's call them Group A and Group B. I will send an SMS to these groups about one individual stock which is continuously going in loss and has no hope of surge up. I will choose that stock because I have taken some money from promoters or bulk holders, having more than 5 lakh shares of that particular stock. Now I will send SMSs to Group A and Group B on different days about that stock going up by 10% or down in the coming days, and ask them to buy as much as possible. Almost half of both groups will get some profit and half will incur losses. Now I will select the members from both groups who get profits by call or through mail, and delete or block members of both groups who incurred losses. Now I am left with database of 1 lakh investors, and I will repeat the same trick of profit and loss as stated above and will divide them into further 2 groups. At the end I have database of 12,500 new investors who have already booked profit previously, on my so-called tips and SMSs. Now these 12.5k customer would think of me as equivalent to God at trading because of my free and sure shot tips, that made them profits. I will somehow convince them to join some random financial advisory firm, or the company from where I bought those 4 lakh traders database. And surely half of these 12.5k will join the firm, for at least a year or more than that. 12,000 Indian rupees minimum as fees for a year equals 12.5k 12k, 7.5 crores, for at least a year both. Mr. Fraud Kumar and the broker X will collect 7.5 crore of corpus with no initial capitals. Now Mr. Fraud Kumar and that broker X will equally get 3.75 crore each and start for the same game to fool other new traders. So without any capitals, market education, etc., Mr. Fraud Kumar made 3.75 crore. This is how SMS and free tips game works. 2. The second and most stupid mistakes I repeatedly did while selling was not to figure out the DP charges details. Most brokers won't mention this charge in their brokerage calculators, as you can see in the zero-day calculator. If you buy 2 shares at 500 Indian rupees and sell at 505 Indian rupees in delivery, after T plus 2 days, they actually show you the net profit is 7 Indian rupees and 92 paise. But here is a catch. Actually you are in loss. There is something called as depository charges of 13.55 plus 18% GST equals 15.91. DP charge applies on sell side only, so theoretically you are in loss of minus 7 Indian rupees and 99 paise, which can be verified in the ledger. I lost almost 2,000 Indian rupees in DP charges in few months, while thinking that I was making profit. 3. Never buy and sell at same day while checking CNC. The very first day of my entered in stock market, I bought M&M at 755 and sold it at 764. 3 minutes later I thought I had made a profit of 9 Indian rupees in no time, and how easy stock market was. I will surely become millionaire in few months. LOL. After 5 days I checked my ledger. They have deducted 47 Indian rupees for call and put option and imposed penalty. If you are taking delivery, make sure to sell after 3 days. Otherwise you might charge some of your profit/loss as penalty. For more information go btst/atst, buy/acquire today, sell tomorrow. Z-Connect by Zerodha. 4. Never buy a shares, which is continuously falling down, before 3:00 p.m. Always buy in 3:15 p.m. to 3:25 p.m. in case of delivery. 5. Don't believe in SMS, WhatsApp, Telegram groups, TV and newspaper recommendations/tips. They are highly biased. These so-called experts are one of us, they are not God. Trust me, nobody can predict stock market. Do your own research before entering into any stock. You can't feel the pain or joy of stock market until you mentally involved in it. 6. Use Stock Screener for Indian stocks. Screener. In, for world market forex charts, currency charts. Free. Investopedia, sharper insight. Smarter investing. Indian stock/share market, Sensex, Nifty, stock/share prices, share market live, stock/share recommendations, hot stocks, stock market investing, BSE, NSE, derivatives, best stocks to buy, penny stocks India, Varsity by Zerodha Markets, trading, and investing simplify, National Stock Exchange of India Limited. 7. Always check the stock holding pattern of the company in which you plan to invest. If promoters holding more than 60%, you might consider it as little safe investment as comparison to company in which promoters hold less than 50%. For example, you can check GM Breweries stock holding pattern, GM Breweries Limited, stock shareholding pattern, Value Research Online. Stock holding pattern tells us how much top executives interested in company. If they're holding more than half, they will work their ass off to climb high. 8. If you want to learn stock market, don't blindly believe in what these stock veterans says. Note, I respect them all. Do and create your own strategy, analysis. Who know, you might be turn out to the next Warren Buffett, Rakesh Jhunjhunwala. 9. If a share is continuously surging up, does not mean it never down, and vice versa. To better understand about surge or dips of any share, there is a term called beta. Avoid buying or selling share in panic. There is something called correction buy only once market seems to adjust after oversold or overvaluation of in stock. Don't follow the herd. Also check price to book value before entering into any share. 10. I recommend new traders not to buy penny stocks. Penny stocks in the Indian stock market can have prices below 10 rupees. Such stocks are highly illiquid, no buyer, and vulnerable to easily price manipulation. Primarily, it seems great idea to add sound numbers of penny stocks at very low price, but there are few negative consequences of having penny stocks. Sometimes you might have no buyer available for your penny stocks in the market. You might stuck your capital amidst this. 10. Always check traded volume of that shares which you plan to invest. Volume play a significant role in share market. Most of the time, the impact of trading volume is relatively neutral. Trading volume in itself doesn't affect stock price directly, but it does have a huge impact on the way that shares move. Investors who look at thinly traded stocks need to be aware of the heightened volatility involved before they buy. 11. I have seen people saying, like, invest for long term, you surely will get some handsome return. Let me clear this with some well-known stocks. Does long term really pay you off? Stock markets are fascinating. Indian stock markets can compete with the rest of the world for the success stories, scandals, intrigue and the tales of disasters. It is said that stock markets are the barometer of a nation's economic progress. It is often debated, but the majority argument favors this statement. Stock market has given returns which are higher than any other asset class. Then there are the great stories of Infosys, Wipro, Eicher Motors giving unimaginable returns on investment. But there are two sides of every coin. The story nobody likes to tell. In the Nifty index, There are 50 stocks. Nifty actually means NSE 50. Oddly, though at present there are 51. These stocks are based mainly on market capitalization. When a constituent loses value significantly, it is removed from index and replaced by another stock. No one talks of these stocks which got removed. They were the stars of the day at some point of time and are duds today. Those were the investment ideas of that time and relegated to horror stories now. I will talk about this aspect which no one talks about. The wealth destroyers. These stocks may be not in favor presently, but were the flavor of the month at their prime. They were part of the Nifty index or otherwise very highly regarded and traded. Today they are shunned and forgotten, but there are real people holding these stocks wondering how they will ever recover their money. Nifty going up does not have a meaning for them. 1. Reliance Communication. On Jan 08, 2008, the stock traded at a lifetime high of 844 rupees and 70 paise. The lifetime low was around 30 rupees few days back. 2. Suzlon Energy. The huge fall in this stock made me look for other similar stories. It was added to Nifty in 2006. In 2008, it traded above 2,000 rupees and then there was a stock split. The comparison is made taking into account the effect of splitting. The lifetime high Jan 09, 2008 412 rupees and 88 paise. The lifetime low August 28, 2013 5 rupees and 70 paise. And the funny part is, you will get to hear on business channels that Suzlon Energy has gained 158% in last 3 years. 3. Unitech. It was a Nifty stock in 2008. It was valued highly and was at a high of 546 rupees and 80 paise on January 2, 2008. What is the current price? 8 rupees and 65 paise. It is around 1% of the high price. Can the investor ever expect to make good their losses? 4. DLF. From a high of 1,225 rupees in January 2008, it trades for around 147 rupees today. Appears better than the others listed above, but 90% loss is not something to be taken lightly. Even if it goes up by 100%, it will be nowhere near 1,225. 5. Himachal Futuristics. In December 2000, one of my friend bought for 1,560 rupees on one day and sold for 1,605 rupees next day. A day later it was 1,675 rupees. He blamed himself for not taking profit. Few months later was shocked when he saw a price of 90 rupees in April 2001. Today it trades at around 29 rupees. Do you know what was the highest price? 2,578 rupees and 5 paise on March 8, 2000. In 16 years, the value of investment has come down to about 0.5%. A stock value cannot fall 100%, but it is as near as you can get. 6. Jai Prakash Associates. It was part of Nifty, a big conglomerate in construction, power and cement business. In January 2008, the high was 339 rupees. Now it trades for 21 rupees. Why this story needs to be told? It is a widely held belief that in the long run, markets give good returns. This belief is true, but the indices do not give the true picture. In most of the above-cited cases, the high price was in January 2008, except HFCL, when Nifty was around 6,100. Today, Nifty is at 11,000, but these stocks are at just a fraction of their highs. Market has gone up, but they continue to be laggards. I have listed only a few. There are hundreds of such horror stories, so there is no guaranteed return in short term or long term. If one could use his wisdom wisely, he can make money even in bearish market. If one couldn't, he can't make even in bullish market. Hope this will help up to some extent for new investors. Have a nice day. Edit 1. Thank you. Shrey Marwahab were suggested and edited for my answer. Answer by Aishanur. Common mistakes made by the investor in stock market. I don't call it mistakes, I called it experience. Stepping stone to success. Investing in the stock market is a good way to plan for your future, and the earlier you start, the more you will get out of it. Saying that, there are some common mistakes made by first-time investors that can reduce profits. Not having a plan. Successful stock market investors have a solid plan and they stick to it. New investors on the other hand tend to go blindly, like a boat without a compass, and therefore get lost and stranded at sea. Know your appetite for risk. Another mistake first-time investors make is not thinking properly about risk versus reward. They tend to invest in riskier investments than they really have an appetite for. Then when the value of the riskier investment declines, they will panic and sell out of the investment. Don't invest your emergency money. The most common mistake is investing money in the market that should actually be kept in an emergency fund. Slightly differently, the mistake is investing money that you know you need to spend in the near to medium term. Not understanding the risk. Every investment comes with a certain amount of risk. That is the nature of the stock market and of all investments. Newcomers often don't properly evaluate the risk of their investments or their own tolerance to that risk. This can cause them to make flamboyant moves with serious life savings that quickly land them in the dump. Short-term thinking. Many new investors rush to make their first stock market investments. The stock market isn't some sort of get-rich-quickly playground. Selling out in a panic. If you do have a long-term plan in place and you understand the stock market movement is best understood over the course of years and not weeks and months, then you probably won't be in much of a panic if stocks start to decline. Stocks rise and fall all the time. Playing the guessing game. Playing the guessing game with stock market investments is exactly the same as gambling. It is your ability to work with stock market data and other relevant channels of information that distinguishes the two. A real investment is not made on speculation or on the basis of a rumor that you heard, but on a valuable opportunity that you have researched and which looks like it will pay enough long-term profits to justify the risk. Too much attention given to financial media. Chasing performance. Investing cash you can't afford to lose. Leveraging up. Playing penny stocks and fads. Going all in with one investment. Zero confidence in your strategies. Avoiding money management. Your trading psychology. Before investing, learn more. This is for those who want to spend more time in their stock investments. There are a lot of venues available to increase your knowledge about stocks investing, which can be rewarding in the end. Invest more. With more savings, invest in more than one company and industry as a form of diversification. Investing more also gives you the benefit of seeing more significant earnings during favorable market uptrend. Check more. Finally, check your stock portfolio from time to time to see if it's working as planned. You may want to dispose stocks that are not moving and replace them with more aggressive ones, or add more conservative ones to reduce your risks. The most important thing is to make sure that you're investing. Source: Google. Tips to invest when the market is not favorable. When market is not in favor, people tend to save more and spend only for the basic requirements and not on luxuries. So invest accordingly for the companies dealing with type of product they sell. Never ever overpay for any stock. Try to buy tangible share of the company, which are trading below the book value of the company. Try to diversify the investments in terms of industry. Look for press release, news, announcements of the company before buying the shares, as it might happen that the company is performing extremely worse and later have a possibility of high performance. If you want to invest in stock market, then it's better to go with Zerodha Discount Broker. India's top discount broker Zerodha. Equity investments are zero brokerage. Coin Zerodha. Mutual funds invest directly. Without broker, no need to pay commission. Varsity Tool. We can learn stock market from basics. Open an online trading and demat account with Zerodha and enjoy the lowest brokerage. Regards, Aisha Nior.